Welcome to Taking Stock for Friday, May 23rd. I'm Jason Yin, and joining me in this episode is my colleague Charlie Song. Great to have you participating again, Charlie.
Yeah, great to be here, Jace.
Fantastic. Well, before we get started, a quick and yet important reminder that the information we provide today is only of a general nature and should not be taken as personal advice. Remember that share and equities are volatile and that past performance figures should not be relied upon as a guidance for future performance. Well, this week we've got a lot to unpack, Charlie, from the RBA's dovish tilt to surging commodities and also a big shakeup in the small cap gold space.
Yeah, that's right, Jace. Let's start with the Reserve Bank of Australia, which surprised the market earlier this week by cutting the cash rate by 25 basis points to 3.85%.
Hmm.
What really caught attention, though, wasn't the size of the cut or the fact that we made a cut, but it was the tone from Governor Bullock, who hinted at further easing if inflation remains within its forecasted path. The market's now pricing in at least one more rate cut by the end of the year.
Well, it seems like the message is pretty clear, Charlie. Growth concerns are rising, and the RBA is trying to provide a little bit of a breathing room. But from an equity market perspective, that's generally supportive, especially for rate-sensitive sectors like REIT and also in the technology sectors. But on the other side of the Pacific, Charlie, things look a lot different, don't they?
Yeah, absolutely. In contrast, the US Fed remains cautious. There are no cuts expected until late 2025.
Mm.
And this week, we saw bond yields spike to multi-month highs. The US 10-year surged past 4.6% after hotter than expected services inflation and hawkish federal minutes. So that divergence between US and Australian rates is driving a lot of currency volatility, and it's also creating a more complex backdrop for global investors.
Complex it is. And even further complicating this issue, Charlie, is the recent surge in commodity prices. Oil prices jumped back up above $60 a barrel, and gold hit almost a fresh all-time high amid renewed tensions in the Middle East. Traders are a little bit worried about the disruptions to supply chains, especially across the Strait of Hormuz.
Yeah, there's clearly some concerns that further geopolitical conflict may disrupt that very sensitive oil supply chain. And
Mm.
while short-term supply fears are pushing oil prices higher, the medium-term outlook also remains uncertain, with OPEC production continuing to increase and global demand trends potentially weakening. So for
Mm.
gold, strong central bank buying and geopolitical risk are both causes of this continued bull run.
Well, speaking about the bull run, Charlie, there are a number of strong performance that we've saw across the company front. Starting off with Technology One, the company has been reinstated as a star growth stock, and this is after a strong first half 25 result. Profit before tax was up 33% to around $82 million, and the annual recurring revenue grew 21% to 511 million, hitting its FY25 target guidance 6 months early, Charlie.
Yeah, and importantly, return on equity has improved to 36% with net profit margins at a very healthy 24%. Technology One continues to benefit from its SaaS strategy,
Mm.
software as a service, which bundles its software, implementation, and support into one holistic subscription. That's accelerating software delivery timelines and helping customers get faster value from their investment.
The company's UK's operations are also worth noting as well, Charlie. Annual revenue in the region rose 50% to 43 million, and this was helped by a number of key wins, especially the Arlington Borough Council, and this is T&E's first major borough client in that region. Now, management's FY25 guidance of 13% to 17% profit before tax growth is slightly below consensus forecast, Charlie. However, management hinted at the analyst call that they are hoping to hit the upper end of that guidance range. So that sets a bit of positivity in markets after that call. Still, with the stock trading near all-time highs, Charlie, investors should stay alert to any of the downside risks.
Yeah, you wouldn't believe how many stocks are hitting all-time highs. We said so only 1 month ago. turning to Dexus, DXI, Dexus is an industrial REIT which has remained a star income stock. It's guiding for a 16.4% dividend in FY25, which equates to a forward yield of about 6.1%. Its net operating income has slowed to 2.4% amid higher vacancies. Releasing spreads remain strong at 12.2%, even if they are moderating.
In terms of the REIT's development pipeline, Charlie, it's roughly estimated to be around 270 million, and management is targeting yields to improve to around 6% to 6.7%. From a gearing perspective, things look a little bit conservative as well at around 28% pre-committed spend. And with finance costs trending lower, the REIT's balance sheet seems to have enough room to maneuver, even if there is a bit of a softening in the leasing market, particularly in Victoria, where business sentiment is rather weak.
Yeah, it's not the best situation here in Victoria, is it, Jace?
Hmm.
Finally, Catalyst Metals, CYL, has entered a trading halt as it seeks to raise $130 million to double its gold production in the Plutonic Gold Belt. The capital will be used across mine development, exploration, and working capital, aiming to ramp output from 85,000 ounces to 200,000 ounces at a cost of $2,000 per ounce, which is much below the current gold price.
Hmm.
The institutional placement is priced at $6 per share and represents around 9.6% of issued capital.
Post the equity raise, Charlie, Catalyst's pro forma cash and also bullion balance would sit at roughly 210 million. And this would obviously support its development as well as leave room for any strategic M&A that could come about in the future. A pretty bold move from management, Charlie, that could signal intent, but execution obviously remains key in this sector.
Yeah, that's right, Jace. And onto the corporate calendar, we have Star Growth Stock, Fisher and Paykel Healthcare have their annual result next Friday.
And in Under the Microscope this week, we turn our attention to accounting software provider Xero. Following analysis of its FY25 financials, we have transitioned the company to a borderline star growth stock, Charlie. With top line momentum running strong, there was a little bit of a decline in terms of return on equity this period, which raised some concerns about capital efficiency. Can you just run us through some of your findings, Charlie?
Yeah, that's right, Jace. The fall in ROE that we've seen in this 6 month period is
Hmm.
largely a function of rising balance sheet equity as Zero moves into a more consistent phase of profitability. That means they're retaining more earnings than ever and their equity base is growing. While operating earnings and cash flow continue to grow, retained earnings have actually grown a bit faster. They're not really reinvesting a lot of those earnings back into their projects just yet. As a result, the business has actually shifted backwards more towards growth over margin expansion.
Right, that's pretty interesting. From the looks of it, the underlying fundamentals still look or appear pretty robust, Charlie. The revenue growth was around 20%, and management delivered double-digit growth across subscribers and also average revenue per user or ARPU. Now, free cash flow margins also reached 24%, and this was the result of a strong Australian tech sector, which sort of reinforces the longer-term value creation that this company possesses.
Yeah, the average revenue per user growth has benefited from recent price increases over the past few years. But we think that, and management is saying that that lever that they've used is now moderating, and they're probably not going to be using it as much as inflation goes down. The focus is now really shifted to upselling and product mix improvements. That's basically them saying that we're going to try to get them onto more expensive plans and try to get them to use our ancillary services. Management is clearly prioritizing the market share gains, particularly in underpenetrated or newer markets like the US.
Well, that seems to be quite evident in management's FY26 guidance, Charlie, where operating costs are expected to be around 72% of revenue, which is only marginally lower than what we've seen in FY25. It also highlights an ongoing commitment by management to invest in anything growth-led, underpinned by confidence in their platform's scalability and also their strong customer retention as well.
Yeah, and to be fair, we do think Xero has a lot of scalability from a
Mm,
business model perspective. Obviously, most of the costs are fixed. There are some additional variable costs that come into play when you enter new markets and try to, I guess, attain more market share, but it's largely a fixed cost base. So that means over time, if the company does grow with the market or even increase its market share, it should see a very large benefit to its bottom line earnings. Customer retention within that software space is typically and historically been very high, given the
mm.
nuances of these platforms and the retraining that has been done in order to switch to a new platform. Really, the key long-term question is whether Xero can balance their newer and more focused growth orientation with a sustainable increase in its margin, especially outside its core ANZ markets, where it's already seeing pretty large margins and maturing growth. Execution will be critical, particularly if they aim to reassert pricing power in more competitive geographies.
It's time for our question of the week, and this one picks up on a thematic that we touched upon earlier. With the RBA turning dovish and also the US Fed holding firm, how exactly do differences in interest rates between countries influence their exchange rates? Now, this is a pretty interesting question. Normally, we advocate blocking out the macroeconomic noise and focusing on company fundamentals. However, this week we thought it might be useful to explain the real world impact on equity markets when there is a divergence in foreign currencies, particularly as interest rate differentials come into focus. As the RBA turns dovish and the Fed remains on hold, there is a widening interest rate gap, which is one of the factors that have led to the recent Australian dollar weakness against the US dollar. Now, generally speaking, when one country's interest rates fall relative to another's, its currency tends to depreciate and capital flows chase higher yields.
Yeah, that's right, Jace. And underpinning this relationship is the concept of interest rate parity.
Hmm.
That's the idea that differences in interest rates between two countries are over time offset by movements in currency exchange rates. It's a theoretical anchor that helps prevent arbitrage between bond and currency markets. But in practice, it's a key reason traders are glued to shifting rate expectations and inflation outlooks.
With the US 10-year yields pushing above 4.6%, while Australia prepares to cut rates or have cut rates this week, global investors are favoring the USD for its superior yield, and this has placed further downward pressure on the Aussie dollar. Currency markets are also forward-looking, and these shifts can quickly feed into broader capital allocation decisions.
And that brings us to equity market implications. A stronger US dollar, for example, can weigh on US multinational earnings. That is, companies in the US that have divisions overseas, whilst also lifting the cost of capital globally. High US bond yields reduce the present value of future earnings, especially for longer duration, higher growth stocks, and can prompt a repricing across equity markets.
That's right, Charlie. And we've also seen a return of so-called bond vigilantes. Now, these are investors who offload government bonds in response to fiscal or monetary policy or views that they don't really share or think are unsustainable. And these actions by this particular group of investors can push yields sharply higher and also add another layer of volatility to markets.
So while falling rates in Australia is generally supportive for local equities, the global backdrop, rising yields, currency divergence, and shifting inflation expectations reminds us that valuation discipline matters. And macro forces, while often background noise, can have meaningful second order impacts on company fundamentals.
That's right, Charlie. Well, that wraps up another dynamic week in markets. Thank you, as always, for your insights, Charlie.
No worries, Jason.
Now, between central bank pivots, geopolitical uncertainties, and also company-specific developments, there is plenty for investors to stay on top of. For any members who would like to get more involved, please consider joining us for Lincoln Live every Monday. Thanks for tuning in. I'm Jason Yin.
I'm Charlie Song. Have a happy, healthy, and prosperous week ahead.